before we start about how we come out of this stronger, let's talk about where we are right now. Where are we?
Listen, I mean, for markets and for the economy, we're in one of the most uncertain periods we've been in a long time, and well, quite frankly, in a generation. We have never had an experience where our economy is tangibly slowing across almost every piece of data. Economy is slowing. You're starting to see it work through in the claims data and the unemployment data, and we think over the next couple of employment reports, you're going to see an economy or a hiring dynamic that's different. And you've got a central bank that's got as its singular focus today, despite the fact its dual mandate is full employment and price stability, that has got to bring down inflation. So it is a construct that the markets have a hard time dealing with. How much will they let the economy go? How much with inflation, which we think will come down? You're certainly seeing indications of that. You're seeing in the market's pricing of it. So it's a very challenging period to think through when you're trying to evaluate risk versus reward. What are interest rates do in a portfolio? What are stocks, high yield bonds do in a portfolio? And I think the markets haven't reconciled the solution to that yet.
And how much of that is the markets and the underlying economy, and how much of it is policy? I know that BlackRock has a terrific chart basically indicating, it surprised me, in recent years the volatility in monetary policy has driven the investments more than the investments have.
So David, it's a pretty incredible thing, and part of what we're trying to illustrate on this report is if you've been investing 20 years ago, 10 years ago, it was all about the central bank's reaction function to the economy and how the central bank would react when inflation or employment moved too far away from normalcy. The last 10 years, and certainly anybody we've hired or worked for us that's been there 10 years, has been an environment where the central banks are functionally all you have to focus on because they are driving the dynamic around how prices are moving. Why is that the case? I mean, listen, you need aggressive monetary policy. When you go through a financial crisis or you go through a pandemic, you need aggressive policy. But there's been this process of tweaking to get back on the line that I would argue is creating more volatility to markets. You know, I would argue, including this central bank, including the Fed, we need to get to neutral quickly. Get to neutral. The system has an ability to recalibrate itself, be flexible. I always say high prices are the cure for high prices. The U.S. economy is incredibly adaptive, and you're seeing it. It was a good article today about, you know, you look at gas prices higher, consumption comes down. The system recalibrates, but we've become used to the central bank is kind of trying to put us back on a line of 2% inflation and full employment. And I would argue it's actually creating more volatility at times than is warranted by how much the economy actually gyrates.
When you say get back to neutral, we heard from Chair Jay Powell in his testimony before Congress this week saying he still thinks neutral is around 2.5%. But even he is saying now we may need to go above that. You have other people saying we need to go way above it in order to really put a stake through the heart of inflation. Is that wrong?
Listen, I don't think you have to go way above it. I think the chair is right. And I think what they're doing now is exactly the right policy. I know, I and others have been critical about we waited too long to move, and I think the Fed has been clear on that being the case. But there's a question of what is the trade-off from if you get to neutral and get a bit beyond. We shouldn't be at easy policy like we are today. Get to neutral, do another 75, get closer to neutral, maybe do a 50 on the back side of that. You know, you think about what you could do, fiscal policy, solar, battery. You've seen some developments recently. What you could do on precision ag to help the food market. Multifamily housing incentives to build more multifamily. Housing affordability is really hard, is really expensive today. Multifamily is going to be, people are going to stay in rental. We need more development of multifamily. These are fiscal initiatives that need to come in and can be, and by the way, have a real velocity to them, create multiplicative economic impacts. Just keep raising rates and taking people out of work. It's a blunt tool, and maybe it doesn't work, and maybe it doesn't bring the inflation down. I just don't agree. I think the Fed should get to neutral, maybe a bit through it, as the chair has said, and then see where you are. How fast the economy is slowing before you say, gosh, we got to go so far past. I just don't agree with that.
So, Rick, that's some advice for the policymakers. What about for investors? Give us some investment advice here. Where are we right now? For example, you allocate both for equities and for debt. You have fixed income. You do both. Where are we right now in the 60-40?
So, I mean, one of the most interesting things is the interest rate markets. The interest rate market has decided that the Fed will never get to do what people are saying and go much further. I mean, this week was extraordinary about the market said, okay, the Fed's never going to get to do it. The economy's slowing. And it's almost as if the Fed announced they're easing how fast rates are coming down. So I think the market has said you're not going to get there around because the economy's slowing too fast. listen, I still think you have the risks and interest rates. I think the central bank is going to try and get rates higher. So do you take a lot of interest rate risk today? I still think you have to be moderate in terms of your interest rate exposure. So we're keeping that down. The equity market, is still the liquidity, the uncertainty. It's just okay, and we're looking at certain areas that we think are durable that have really gotten hit. Some parts of the technology area, like software, where companies need to be more efficient to bring their costs down. So I think they're parts of the equity market. The credit markets have become really interesting. And we've started to add some in credit. I mean, you can buy high yield now back at 9%. So think about real rates. We lived in a zero interest rate world, and your high yield was trading at 3.5, 9. You're starting to get. I still think you got to be careful in portfolios. You still got to run a high level of cash. You still got to let things work through around these uncertainties. But we're letting our cash run down a little bit by a little bit more credit. And but I still think you got to be patient and let things play out. We're going to get a lot of data on the economy, a lot of data on monetary policy. By the way, not just in the U.S., Europe is going through a more significant slowdown than the U.S. China's evolving. So there's a lot to come in the next couple of months. We think taking a little bit more risk, but not racing in, I think makes sense.
BlackRock also had an interesting chart comparing private credit with high yield.
Yeah. So it is an extraordinary thing that I have, quite frankly, haven't seen in my career nearly to this extent, maybe at all. That some of the private markets are slower to adjust. Some people say they're less volatile. I don't know why less liquidity means they're less volatile. Organically, you don't mark them to market as much. But it's interesting, and I keep seeing private investments brought to us, and I ask the question, have you seen the public markets? Like, why is that pricing where it is? So, I think I think two things have to happen. One, my sense is the public markets will stabilize and start to improve when we get a sense for the Fed and the ECB are going to slow down the policy adjustment. So that improves, and then I think the private markets need to, their rate of return hurdles have to increase a bit. The cost of illiquidity has to go up a bit. So my sense is both will happen. But right now there's this weird, it's sort of like when people sell houses, you just step back and don't sell them for a while because you don't like the price. And I think similar to private markets, they need to adjust a bit, and I think both will happen. But I think that adjustment period takes some time.